The data is showing us that the economy is a lot weaker than everybody is saying. The difference is inflation is much stronger. So now we don't just have a weak economy, we have strong inflation. We have stagflation.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
We got more bad economic news that came out during the week, but I want to focus on the bad news that came out mainly today. We got some really bad news from the Philly Fed, the Philadelphia Fed Manufacturing Index for the month of April. Remember, the Biden administration wants to keep taking credit for the strength of American manufacturing. We've got this strong economy. We're manufacturing again. Well, the numbers belie those comments. The number for April was supposed to improve slightly from the minus 23.2 from March, which was a pretty bad number by itself. It was supposed to improve to a slightly less bad minus 19.4. Instead, it collapsed all the way down to minus 31.3. In order to find a Philly Fed manufacturing number that low, you've got to go back to March of 2009. That was about the bottom of the Great Recession. In fact, March of 2009 is when the stock market bottomed. The S&P was down something like 50% at that point when the market bottomed out from the big collapse from the financial crisis of 2008. Maybe it was 40, 50, I forget the exact percent. But March of 2009, that was where the market bottomed. And so that's when you got a Philly Fed number this bad. In fact, the number is now down for 8 consecutive months. I'm not sure when the last time that happened. It's down for 10 out of the last 11 months. I don't think that's ever happened to an economy that wasn't already in recession. So this number is very consistent with an economy in recession. And if it's not in recession, it's certainly suggesting that we are on the cusp of one. Also, the jobless claims number came out today for the week. It was a slight uptick, but more significant than the fact that we got 245,000 claims, which was just above the 242, was that we still revised up the prior week from 239 to 240, but these numbers are very elevated over where they were. These are the highest numbers really that we've seen since January of 2022. And if you look at the increase in continuing claims, it's now at the highest since December of 2021. So unemployment is quietly becoming a bigger problem. It's not screaming anything right now in the headlines, so people can still ignore it. But this problem is going to get much, much bigger. Also, we got the leading economic indicators for March. Now, this index had been down for 11 consecutive months. And following today's decline, it's now down 12 months in a row, an entire year. You know, this is not a calendar year, but 12 months is a year of falling leading economic indicators. It's pretty hard to claim that the economy is strong when these forward-looking indicators are so weak. In fact, the consensus forecast was for a minus 0.4. And that would have been just a slight decline from the minus 0.3 from January. Well, the January minus 0.3, that got revised even worse to minus 0.5. And the March number was not minus 0.4 as expected, but minus 1.2. Again, this is one of the weakest LEIs that we've seen. And in order to get a 12-month streak of negative leading economic indicators, you have to go back to the Great Recession. It was between 2007 and 2008. It was a year that spanned both of those because remember, the Great Recession began in mid-2000 or late 2007 and ran through 2008 into 2009. It was within that context that we had 12 months in a row where you had negative leading economic indicators. Well, we've got that now. And apparently we're not even in recession. We've got this supposedly strong economy, yet we're seeing a streak of weakness in the leading economic indicators that we haven't seen since the worst recession since the Great Depression. So the data is showing us that the economy is a lot weaker than everybody is saying. The difference is inflation is much stronger. So now we don't just have a weak economy, we have strong inflation. We have stagflation. And again, this is a problem that is global, and it's not because it's just a coincidence that all these countries are experiencing inflation, and therefore we can't blame anybody for it because everybody is suffering for it. No, everybody made the same mistake. All these central banks printed too much money. They all kept their interest rates too low. One of the chief offenders, the Bank of England, I remember listening to a lot of these press conferences where the head of the Bank of England kept talking about how inflation is too low. We got to keep interest rates, at zero, wherever they were. We got to keep printing money because we don't have enough inflation. Well, look at what they just got. We got a lot of inflation numbers on the week, but the ones out of the UK were the worst. And there they were looking for increase of 0.5 in March. And instead we got an increase of 0.8, so worse than expected. And now the year-over-year increase, despite the rate hikes that they've had thus far in the UK, the year-over-year increase in consumer prices is 10.1%. They have a long way to go in the UK. Rates have to go a lot higher. Government spending needs to be substantially cut. None of that is happening. Nobody at the Bank of England is going to be talking about inflation being too low, probably for the rest of our lives, because it's never going to be too low. It never was too low. That was just made up. That was a pretense. But now it's clearly much too high, and there is no way that they're going to get that inflation rate back down below 2%. They're probably not going to get even close to 2%. And the same thing is true with all these other countries in Europe. Everybody has let the inflation horses out of the barn, even Japan. I'll look at Japan's inflation numbers because they came out about an hour ago. Japan still has one of the lowest inflation rates in the world, but it's still not below 2%. The March number came out up 0.3 on the month. That's not an insignificant increase. And the year-over-year change in consumer prices is 3.2%. Even if you X out fresh food, it's 3.1% year-over-year increase. So it's not the 10% that they got in the UK. But remember, not too long ago, the Japanese had stable prices. They even had a few years where prices dropped slightly. But now they're rising. They're rising a lot more than 2%. And these numbers are going to go up. Why? Because interest rates are still negative. I think their overnight rate is minus 0.5 or minus 0.1 rather, I think is what it is. But the JGB is still targeting the yield on the 10-year Japanese government bond, or the Bank of Japan is targeting that yield at 50 basis points. The inflation rate is over 300 basis points, yet the 10-year yield is at 0.5%. And so this requires a lot of inflation. A lot of yen has to be printed to buy up all these bonds, because who in their right mind would want to lend money to the Japanese government at 0.5% if inflation is 3%? And of course, it's not going to stay at 3%. It's going to go up. So inflation is this big problem. We didn't have the big inflation problem in 2009 that we had now. The last time you had these really bad numbers on the economy. But, not only did we get bad economic numbers today, we got some bad corporate earnings. Particularly, I want to talk about Tesla, because this is a stock that I have been warning about for years because there was so much, hype surrounding Tesla. And I'm not saying that, they're a bad company and that they make bad cars. They're a good company and, they make good cars, right? But a lot of the people, like the Kathy Woods out there who got into Tesla early and it was a big bull, they were always claiming that, hey, Tesla's going to make all this money because they dominate the electric vehicle market. And so as the market grows, they're just going to, write their own ticket. They're going to make all this money. And you go back to a lot of my podcasts for a couple of years ago when I talked about this, I said the mistake that all these bulls are making is they're underestimating the degree to which Tesla is going to face competition in the future. Because if you build a better mousetrap and you start making money, then other people want to build similar mousetraps and compete away your market. And that's what's happened. That's what I predicted would happen. You have all of the mainstream automobile companies now have EVs that they're producing. And so Tesla doesn't have this market all to itself. It has to share the market with a lot of major automobile companies that have massive distribution, showrooms all over the world. And as a result, there is a lot of pressure on Tesla to lower prices to try to maintain market share and fend off all this competition. And so today, Tesla came out with earnings that were way below estimates because margins have collapsed because Tesla has been forced to cut prices in a very competitive market. And Tesla stock dropped 10% on the news. The shares right now are trading at, let me take a quick look, $163 a share. The 52-week high was $364. So well below that high. I read on Twitter that after these bad earnings came out, Kathy Wood came out with her price target for a Tesla. And I think it was for 2027, something like that. And her price target is $2,000 a share, right? It's currently 162. I think she said that would give it like a $5 trillion market cap, which means I guess Elon Musk at that point would be a trillionaire if her unbiased, completely reasonable forecast turns out to be true. In fact, even under her bearish scenario, right, her worst case scenario for Tesla, I think was like $1,200 a share versus the 163 it's at now. So she still doesn't get what's going on with this stock. And that is part of capitalism. If you are successful and you make a lot of money, other people want a piece of your action. That is how a free market works. And you can't maintain that position indefinitely. Now, you could try. Take a look at a company like Apple. I mean, Apple has still maintained a pretty healthy slice of that market. It does have competition, but it continues to put out products that people like, and it's been able to hold on to that market share. The question is, 10 years from now, 20 years from now, will that still be the case, or will competition have taken a bigger bite out of Apple's profits? It's already happening, though, with Tesla, because Tesla, I think, has faced a lot more competition than Apple in that respect. But also, why is Tesla under pressure to lower prices? Because the consumer's in trouble. The economy is weak. Car buyers don't have as much money to buy new cars as they did before. Why? Well, because they've lost their good-paying job and they've tried to replace it with 2 or 3 low-paying jobs. And they're spending more on food. They're spending more on insurance, on electricity, on everything. They don't have as much money left over to buy a new car. So they got to make do with the car they have. And so as a result, companies are being forced to cut prices, even though their costs are probably going up. But they're selling items that consumers don't need. I mean, most Americans don't need a new car. Some people do, but most Americans have a car. They have a second car, and they can keep driving them. They can fix them, right? And so it's a discretionary purchase. And in a weak economy with a lot of inflation, Those are the exact type of purchases that people cut back on.